In this video, I want to talk about how private equity works. I will consider the key features of private equity as well as its advantages as well as disadvantages. And so here are 10 key features of private equity investing. Number one is private ownership. Private ownership. Private equity involves investing in companies that are not publicly traded on the stock exchange. Number two is long-term investment horizon. Long-term investment horizon. Investment typically have a long-term perspective, often ranging from 5 to 10 years or more, allowing for substantial growth and value creation. Mind you, they're not publicly traded in the market, in the exchange. Number three is active involvement. Active involvement. Investors, especially those in private equity firms, often play an active role in managing and guiding the company's strategy, operations, and governance. This structure is actively managed. Number four is capital commitments. Capital commitments. It requires a significant capital commitment. It requires a huge amount of money, which is typically raised through private equity funds or direct investments by institutional investors and high net worth individuals. The capital outlay is usually very huge. So they get this money from high net worth individuals as well as big investment firms. Number five is investment stages. Investment stages. This can include various stages of company development, from early stage startups, that's venture capital, to more mature companies. This will involve, buyouts or growth companies. So they come in at different stages. Number six is structured investment vehicles. Structured investment vehicles. Investments are obtained, they are often made of they're often made through structured vehicles such as private equity funds, which can pool funds from different different multiple investors. It can also acquire funds from other companies as well. Usually the structure is that this will involve high net worth individuals. It will involve private equity funds, and they can equally acquire other portfolio managing companies. That's how it is structured. Number seven is performance-based fees. Performance-based fees. Private equity funds usually charge management fee, typically between 1% and 2% of assets under management. And this performance fee, they equally charge a share of profits, often 20% of returns above a certain threshold. They may say, well, if we perform above, let's say 10%, we are going to charge 20% of the profit above that particular threshold. Let's say, for instance, the company makes, let's say, 20%, and the threshold is 10%. All right. So any profit above 10%, they are going to charge 20% of it, of that particular profit. And sometimes if they don't really perform above a given threshold, then I doubt they should be able to charge any profit at all. Number eight is exit strategies. Exit strategies. Private equity investments are eventually exited through various strategies, including initial public offering, sales to other companies, or a secondary buyout. That's how you can exit and liquidate your investment. It might be through an IPO. It might be through a kind of buyout. That's how you recoup your investments. Number 8 is due diligence. Due diligence. It requires extensive due diligence and an analysis to evaluate potential investments, including assessing company financials, management terms, and market opportunities. So it involves thorough research before they can invest in any given company. They have to analyze, evaluate the potentials, of the investments, including assessing the company's financial statements and other related information. Number 10 is limited liquidity. Limited liquidity. Investments are generally illiquid, meaning investors cannot easily sell their shares or exit the investment before the planned exit event, making it, it's a long-term commitment. We cannot just wake up one morning and say, I want to sell my investment in a private equity firm. No, it doesn't really work like that. It takes time, for you to be able to dispose your investment and recover your money. Let's look at the benefits of this particular strategy. Number one is potentials for high returns. Private equity has the potential to deliver substantial returns, especially if the companies grow significantly or it is successfully sold or listed in an exchange. Number 2 is diversification. It provides diversification from public markets and can include investments in various sectors and stages of development. They can invest in the company from any sector, from any industry, and also at any stage of the company's development. They can come in and then take control and continue from there. Number 3 is operational improvements. Investors often work closely with the portfolio companies to improve operations, efficiency, and growth prospect. Once they acquire a company, they work hand in hand with the management to see how they can, bring out the best from the company, bring in, improvement here and there that will eventually, increase or reinforce the bottom line. Number 4 is access to exclusive opportunities. It offers access to investment opportunities not available to the general public, not accessible by the general public. It has that particular aura of exclusivity, around it. The drawbacks here include number 1, illiquidity. Investments are less liquid, than public stocks, which funds often tied up for several years before it's possible to exit. So this investment is highly illiquid. You can't just sell at any time. It takes time to be able to sell and recoup your investment, recoup your returns. Number 2 is high risk. High potential returns come with some higher risks, including the risk of complete loss of capital if the company fails. Of course, some companies do fail. As if it is if it's a portfolio component or a portfolio company of a private equity fund, then you discover that the fund involved will certainly bear the brunt of the losses. You have number 3, complexity and due diligence. Complexity and due diligence. So it requires extensive due diligence and expertise to evaluate potential investments and manage them effectively. So not everybody can effectively, conduct due diligence on a typical company. For those who have the expertise, who have the experience, who have the skills, and this is a typical disadvantage of private equity. It's not for everybody. Number 4 is high fees. Private equity investments often have high management fees and performance fees, which can eat into your returns. You have performance fees of 20% above a threshold, and you have management fee of 2% of the asset under management. If you have $1 billion under management, You may pay as much as $20 million as a management fee. That's 2% of the capital under management. So private equity can be a lucrative but risky investment strategy. But it is often best suited for those with significant capital and a higher risk tolerance. It's meant for high net worth individuals, institutional investors. It's not meant for small retail investors like you and I know, because the capital outlay is relatively very, very huge. It's for kind of people you can call accredited investors.